everyone, and welcome. The head of the Federal Reserve, Jerome Powell, just dropped some huge news that could shake up everything from your mortgage to the job market. He's sending a really strong signal about a big shift in the Fed's thinking. And yep, it's pointing directly towards more interest rate cuts this year. So, what in the world did he actually say? Let's get into it and break it all down.
All right, we're jumping straight into the deep end here, because this is really the most important news to come out of Powell's latest speech. He's basically laying out the breadcrumbs for the Fed's next moves, and honestly, the message is surprisingly clear this time.
Okay, so this quote right here. At first glance, it looks like a mouthful of jargon, right? Classic central bank speak. But packed inside this one single sentence from his speech on October 14th is a huge policy pivot. Believe me, this is not just some throwaway comment. This is a very carefully crafted phrase designed to send a very specific signal to the markets.
So let's translate that into actual English. What Powell is really truly saying is that the Fed's #1 priority has changed. For the last couple of years, the big bad guy was inflation. That was the whole battle. Well, now, their main worry is the job market. They see a real risk that hiring could slow down too much, and they're signaling that they're ready to do something about it.
But you might be wondering, why the sudden change of heart? Why this shift from being obsessed with inflation to focusing on jobs? Well, to really get that, you have to understand what the Federal Reserve is supposed to do at its very core. It's all about this really tricky balancing act.
So the U.S. Congress has basically given the Fed two main jobs. It's often called their dual mandate. First, they need to keep employment as high as possible. And second, they need to keep prices stable, which is just another way of saying keep inflation under control. The big challenge, though, is that these two goals often pull in completely opposite directions.
And what Powell is telling us, loud and clear, is that the scales have officially tipped. Right now, the danger to maximum employment is a bigger worry for them than the danger of inflation. So the bottom line is, they are now prioritizing jobs.
So what gives them the confidence to make this shift? It all comes down to this number, 2.9%. That's the current inflation rate. Now, it's not exactly their perfect target, but Powell went out of his way to say he thinks this is mostly being driven by tariffs and not by what he called broader inflationary pressures. In other words, he doesn't see some out-of-control inflation problem that would stop them from cutting rates.
All right, so we've established that rate cuts are very likely on the way. But so what? What does that actually do, and maybe more importantly, what does it mean for your own finances?
You can think of it as a kind of chain reaction. The Fed starts by cutting the main interest rate that banks use to lend money to each other. That makes money cheaper for the banks. Then, in theory, they pass those savings on to us, consumers and businesses, through lower interest rates on loans. The whole idea is to make it more attractive for people to borrow and spend, and for businesses to expand and hire more workers.
And this is where the rubber really meets the road for most of us. A rate cut from the Fed can mean lower mortgage rates if you're thinking about buying a house, cheaper car loans if you need a new vehicle, and maybe even lower interest payments on your credit card debt. It's all designed to get more money flowing through the economy by making it cheaper for everyone to borrow.
Okay, but to really get why the Fed is being so careful with its words right now, we have to rewind the clock a little bit. We have to look at their recent and, let's be honest, very controversial history. What they did during the pandemic is still being argued about today, and it's a huge reason why they're taking the approach they are now.
Back during the pandemic, the Fed went into overdrive. They launched this massive program where they bought trillions, that's trillions with a T, of dollars in government bonds. The whole point was to flood the financial system with money to keep interest rates super low and stop the markets from completely falling apart.
But this whole program got hit with a ton of criticism. A lot of people argued that it mostly just helped Wall Street and the wealthy by pumping up stock prices, which made inequality even worse. Others said the Fed just kept its foot on the gas for way too long, holding rates down and eventually helping to cause that huge spike in inflation that they then had to fight so hard to bring down.
And here you have it from Powell himself directly responding to that criticism. This is a pretty stunningly honest admission for a Fed chair. He's basically acknowledging that, yeah, looking back now, they probably should have done things differently. It just goes to show you how incredibly hard these decisions are to make in the moment versus, with the clarity of hindsight.
Okay, so that's the backstory. That's the context that's shaping how they're thinking right now. So let's look ahead. What should we all be watching for, and when are the next big decisions going to be made?
So it's not just us trying to read the tea leaves. Here's an analyst, Scott Helfstein, from the investment firm Global X. He basically thinks that even though Powell is trying to sound like he's keeping his options open, the writing's on the wall. The expectation on Wall Street is now pretty much baked in: 2 more rate cuts before the end of the year.
So you might want to pull out your calendar because these are the dates to watch. We already had the first cut back in September. Then on October 14th, we got this big speech from Powell. The very next decision is coming up at their meeting on October 29th, and then the final meeting of the year is on December 10th. These are the days we'll find out if all these signals actually turn into real action.
And all of this brings us to the final, crucial, multi-trillion-dollar question. The Fed is walking a tightrope right now. They're trying to pull off what economists call a soft landing. That means they want to slow the economy down just enough to keep the job market in good shape, but not so much that they accidentally push the whole thing into a recession. And you better believe, after all the heat they took for their pandemic policies, the pressure is on. Can they stick the landing this time? That is the big question.